Management Association. It is my sincere pleasure to welcome Davy Gunn.
Thank you, Mo. Good afternoon, ladies and gentlemen. It is my sincere pleasure to be with you this afternoon to moderate the Hedge Fund and Public Equities panel. This final panel includes 5 seasoned portfolio managers who I'll just introduce to you quickly. Murray Belsberg, sitting my immediate right, is the president of Perennial Asset Management. Perennial Asset Management has a dynamic investment strategy to provide consistent market returns in all market environments. Murray has over 30 years of experience in financial services, having worked at Merrill Lynch and First City Trust Company. Next to Murray is Ira Gluskin. Ira is the co-founder and vice chairman of Gluskin Sheff and Associates, an independent wealth management firm. Since its founding in 1984, Gluskin Sheff has grown into one of the largest wealth managers in Toronto, offering in-house investments in equities, fixed income, and alternative investments. Mr. Gluskin has worked in the investment industry for over 40 years and helped build up Gluskin Sheff from just $24 million of investable assets at inception to a public company with a market capitalization of over $400 million. Next to Ira is Jonathan Bloomberg. Jonathan is the founder and chief executive officer of Bloomberg Sen Investment Partners. Bloomberg Sen is an investment counseling firm that manages 3 funds and uses a value approach to investing in the equity markets. Prior to founding Bloomberg Sen, Jonathan was the lead analyst for 3 Burgundy Asset Management investment funds covering North American companies. Next to Jonathan is Andrew Brenton. Andrew is one of the co-founders and chief executive officer of Turtle Creek Asset Management. Turtle Creek is an investment management firm that invests in small and medium-sized companies in North America. Prior to starting Turtle Creek, Mr. Brenton founded and was the chief executive officer of the private equity subsidiary of the Bank of Nova Scotia and founded or held senior positions in the bank's corporate finance divisions. And joining us via teleconference is Monish Pabrai. Monish is the managing partner of Pabrai Investment Funds. Pabrai funds invest in publicly traded equities using a value approach. This approach is outlined in Mr. Pabrai's book, The Don Doe Investor, the low-risk value method to higher returns. Along with his wife, Harina, Monish is the founder of the Dakshana Foundation. We are very pleased that he's able to join us from Irvine, California, via video conference this afternoon, our panel. So, gentlemen, with interest rates at historic lows and equity markets serving up unprecedented levels of volatility, investors are keenly interested in equity and hedge fund strategies that can deliver absolute returns with acceptable levels of risk. So the question on everybody's mind, and the first question that I will pose to each of you today, is in which strategies and asset classes do you see the greatest investment opportunities today? So, Murray, let's start with you.
Thank you very much. I'm going to be taking this from a little bit of a different position from the rest of the panelists, I think. So I'll start with our view of the world. We at Perennial happen to believe that we're on the downside of a credit cycle, and that has the biggest impact on what you want to do with your money today. So we have come through the upside of the credit cycle from 1982 until recently, and during that period of time, aggregate demand was impacted by what people made and what people borrowed, and that turned out basically overall time to have aggregate demand substantially higher than would normally be the case. Since we believe we're on the downside of that cycle today, it means that you should be expecting an environment that is substantially slower growth than we've experienced in the past. Now, we listened to a lot of people today speak, and actually I found it very interesting, and I want to thank Prime Quadrant for organizing this, because I found it quite interesting to listen to what everybody had to say. This morning in the fixed income panel, they were actually quite negative on the world, I would say, and painting a picture from a macro perspective that would fall in line with the way we see the world. In the in the private equity group, they spoke about when was the right time and the wrong time to put money to work in the private equity world. And they basically talked about chasing returns, and when everybody put money in, that was probably the wrong time to put money to work. In the last panel on the real estate side, I think they were talking as well about maybe this being a good time to sell for a lot of cases. I think Jack was quite clear on that, as how he felt. But what we see in the equity markets typically is there's a belief that equity markets go up. You can't really tell when markets are going to go up or down. So the goal of equity investing is just to pick the best companies, know them better than anybody else. We've chosen a dramatically different position for our firm, and the way we look at that today is we think that there's a time to be invested and the time not to be invested, and not at all times can you expect markets to go higher. Since we view ourselves today on the backside of a credit cycle, what we believe that will mean is you will have slower growth in the economic environment altogether, and therefore valuations of companies should be lower than they have been in the past. We're not a doom and gloom organization. We don't think the world is coming to an end. But what we see is going from an environment where you had 3.5% growth rates to an environment that has closer to 1.5% growth rates. And if that's the case, the amount you should be willing to pay for a company will be quite different in the future than it was over the last number of years, where most of us got our investment training. So in that environment, to answer the question in a long way around, it would be, we believe actually a person should be short equities that are dependent on economic growth, and you should be long very high quality fixed income assets, not unlike you saw in the real estate group before us for apartment buildings and things like that, stable income, and expect relatively low returns. So we think today people should not just be focused on what they can make, but they should also be focused on making sure they don't lose their capital.
Great, thanks, Murray. Ira?
Well, that was a lot of fun listening to Murray. So I wasn't sure what I was going to say, but now I've got to go the other way. So first of all, our firm deals with high net worth investors, and today the biggest component of the assets are bonds in various categories, market neutral hedge funds, high income stocks, and only a smattering of old fashioned common stocks. Basically, my interpretation of the world is that you can't give stocks away. People hate them. People who come to events like this want to hear about alternative strategies. In the old days, good old days, at Gluskin Sheff, people would stagger in, they'd say hello, and they'd say, I want to be very conservative with my money. All I want is a modest 12 to 15%, and please don't take any risk. Nowadays, those very same people or their children or grandchildren would come in and say, all I want is 5 to 6. And so the 5 to 6% world is fairly well satisfied. It's not really that easy to achieve. It's easy to achieve, but people want 5 to 6 think they should never have 1 inch of capital depreciation. But anyways, I like stocks. I always did like stocks. And I find they're not very popular. It's sort of public information that mutual funds experience redemptions in common shares every quarter for years. All their increase in assets, if there are any, come from bonds. And the thing that people don't like about stocks is alleged volatility. But I'll give one thought to you that, if you think about Canadian stocks and they go up or down, but in actuality, if you take out resource stocks, just look at the rest of the stock market, you'll see that it's extremely unvolatile. And you can get perfectly respectable yields and you'll make a lot of money. That's my point of view.
So is there a particular focus in the portfolios in the current marketplace? So in terms of stocks that you like, are there particular sectors of the market that you're weighting towards, or dividend stocks?
Yeah, actually, I like real estate stocks. I've followed real estate for a couple hundred years, and there are very attractive valuations, but the most attractive part of the market actually, in my view, are those companies who are able to do business in the U.S. housing recovery. There's one thing for sure that I agree with a lot of people is that Canadian housing is going down, but U.S. housing is going up. It's very difficult to have a hedge fund that shorted Canadian housing and bought U.S. housing. It's almost impossible to produce. You know, for example, the multi-billion-dollar Canadian condo business has no public companies. But anyways, the U.S., they've been in a slump since about 2004. You know, got a publicity in 2008, but actually began 4 years earlier. And the recovery began about 8 months ago. It's not a matter of trying to pick whether today is a good day or bad day. It's something that's going to go forward for 4 or 5 years. So, you know, there's a stock called Brookfield Residential. It's controlled by the Brookfield Group. You know, they know how to manage companies. And the great thing about this stock is it has no research following.
Thank you. Jonathan, where do you see the greatest opportunities today?
First of all, thanks for having me. Proud to be here to support Mount Sinai. The question is thoughts on different asset classes. There we go. And then sort of where to go within the asset classes. You know, I think we've heard some different people speak today. Bonds are at 200-year highs. Interest rates are almost at zero. So I think it's very hard in a passive bond strategy to make money. There are different ways in bonds, but passive bonds is not an area which I think offers a lot of opportunity. You know, real estate, particularly in Canada, in America, I agree with Ira. In Canada, it's, I was talking to someone at lunchtime today who's in that space. It's tough to find value in real estate. And then there's the asset class of equities, which everyone hates. In 10 years, no one's made any money owning, you know, an index in North America. People are terrified, and that's by definition the place where money will be made in the future. To me, I think fortunes will be made in equities. I'm like Ira, I like equities. You can buy equities with a very high earnings yield today. So you compare, we own Oracle. Oracle just financed, borrowed $5 billion for 10 years at 2%. People are buying those bonds. You can buy really good businesses with an earnings yield of 10% versus 2%. So I like equities. Within equities, you know, there's lots of ways to get to heaven. The way that I believe, you know, for us at Bloomberg Sen, and we're a value-oriented firm, and I think everyone has sort of a different definition of value. I mean, to all of us, it means buying a really good asset, hopefully at you know, half price. But the definition of sort of what's good differs by different companies and different people. So for us, where you know what we like in the equity markets today is businesses that you know really recurring businesses with very high margins, lots of free cash, selling a product or a service that's essential, that don't have too much competition, and have a balance sheet that can take you know inevitable volatility or what happened in 2008. So that's sort of our definition of value. So you know, long-winded answer. I think there's not a ton of opportunity in real estate and bonds. There's amazing opportunities in equities if you're looking, and if you can find a concentrated group like we have. Our whole portfolio, you know, the earnings yield in our portfolios 9%, and the businesses are growing their value. I think that's a place where people will make a lot of money going forward.
So, and again, Jonathan, is there a particular tilt in your portfolio toward one sector?
Well, it's sort of characteristic for us. Like we, as I mentioned, you know, I would prefer to own a business today that's not capital intensive. So if if ultimately when inflation does come back, they don't have to go and spend a bunch of money on more expensive capital. So I like businesses that don't require a lot of capital and that have very few competitors, so that they're not going to have their margins eroded. And I think if you can find an industry leader which generates a lot of free cash that sort of isn't going to have a big change in their business and doesn't need their money to reinvest in capital, then that earnings yield I talked about. So if you have a portfolio that's yielding 11 times earnings, 9% earnings yield, and they don't need the earnings to reinvest in their business, they can get that back to you. And that's where I think, that's where I would focus.
Okay, great, thanks. Andrew?
Well, I guess, Murray, I think you're outvoted at the head table so far. I did write down something that you said, though. I wrote down, some people try to pick the best companies and know them better than anybody else. And I thought, that's what we try to do. I mean, that is genuinely the approach that we take. And so we started 14 years ago. And as my bio says, we previously were in private equity, myself and my partners. So we thought a lot at the time about what asset class we want to have our money in, because we invest and commit to have all of our money in Turtle Creek alongside of our clients. And we have, in at prior times, owned bonds. We've obviously done private equity, and that worked out pretty well. But as I think about the 14 years that we've been in operation, there was really only one period where we were not fully invested. So looking back in 2000, we had about a third of our fund in cash. And that wasn't any brilliant market timing. That was simply, we try to own and know good companies. And the prices were going up, in hindsight, quite a lot. And so we were not able to, as we sold bits of some of the companies and the price went up, we weren't able to get that money back to work. But other than that period of time, over those 14 years, and those 14 years, when you think about it, have covered lots of different equity market environments. We've been able to find, in our view, a set of companies to own at prices that are more attractive than cash. And for us, that's our bogey. We'd rather be in T-bills or own pieces of companies. That doesn't mean that I look at the market today and think, oh my gosh, it's so attractive, it's so low. If you take a really long-term view, you could build an argument, as some people have, that prices could drift lower for some extended period of time. So I would then just echo Jonathan's comments. We have a similar earnings yield. It's actually a little higher than 9-10%, but it's similar. And I just think that's a superb place to be. So I step back and think, I'm shocked at the things we can own at the prices we can own them. But that doesn't mean that 3 years from now I wouldn't be sitting here saying I'm really shocked at the prices where things are trading at.
Modish?
Yeah, well, great to be here, and thanks to Prime Quadrant for putting this together and accommodating me from Irvine. We've always been equity investors, and I've always liked to own businesses that are deeply undervalued. And the interesting thing about the markets as we see them today is there's not a whole lot to do. I think it's a mistake to reach for yield. I think one shouldn't look at dividends. One should look at, like some of the panelists mentioned, earnings yield is a better metric than dividend yields. There's a illusion when you reach for high dividend yields and such. So basically, we don't find a whole lot to do, but we found a few things to own that we believe are widely mispriced. So basically, for the broader market, I'm basically agnostic. I think it may be somewhat undervalued, but it could also be fairly valued. But we found a few things, and we don't really talk about the things we own. But if you look at for example, our 13F filings, we basically have found a few names in the financials that people hate, and we think they're mispriced. We found things in the automobile sector because I think that sector has gone through quite a bit of change, especially with the auto bailouts and such. So there's a few things. I think there's a few areas like that. And I think that in these particular areas, the mispricing is quite dramatic. I think that our portfolio sits at probably one of the widest discounts to intrinsic value in the history of the funds. So I'm quite optimistic from that point of view.
And so again, is there a particular tilt in your portfolio in the current market environment?
Well, I would say that if you look at our 13F filings, which show the U.S. equities we own, you would find names like Goldman Sachs, you would find Bank of America, you would find Citigroup, you would find General Motors, you would find Chesapeake Energy, and so on.
Okay, great. Now I'd just like to direct a question to each of our panelists, more specific to their strategies. And I'll direct the first one to you, Andrew. You've said that equities should comprise the vast majority, if not the entirety, of investors' portfolios. What are most people, specifically private investors, missing when they invest predominantly in bonds?
I want to add two important caveats to the fact that we have said that we think that people should have most of their money, and if they have a long enough time frame, all of their money in equities. And I stress the time frame. So what we've said is if people need their money, the cash they need in the shorter term, and by shorter term I mean 3, 4, or 5 years, they shouldn't have that money in equities. But one of the points that we make with our clients, with our investors, is that people generally have a much longer time frame for their investments than they think. Often people will say, you know, I'm retiring at 65 and I'll need to start taking money out. But that isn't the same as saying I need to cash out everything, all of the wealth that I've generated. I had to address this 14 years ago with some people that are quite close to us as to what they should do with their capital. And while they were older at that time and 14 years older now, concluded that the best thing, as long as they didn't need the money in the next handful of years, was to have it in Turtle Creek and to own good quality companies at as cheap a price as we could find. And that's worked out exceptionally well for them. And so now as they are starting to take amounts of money, I point out to them it's really a small percentage of the capital that they have. So as long as people have a long enough time frame, and we think in terms of 10 plus years, we believe that is the right asset class to be in.
How are you raising your hand?
Well, like I like stocks. I said that would be my particular choice, but I must admit that I'm widely diversified. That I own, every product that Gluskin Sheff owns, and I own a lot of the funds that spoke today, and a lot of other funds. I do believe in diversification, but in terms of the great majority of people, this is, sort of a basic lesson. That what I learned is that, we had clients who made big money between 2001 and 2007, and they were happy. Then they lost money in 2008. They were much more unhappy than they were happy about the previous 5 or 6 years. Now, I could say that all these people that we deal with, there are very few pure people, zero. There's no board money. These are people who can afford it. They can afford the loss. And, they, regardless of your time horizon, even very elderly people can afford to take a long term because the money they're investing is usually for their children or their grandchildren. Actually, they can have the longest time horizon. So time horizon isn't a factor. Nevertheless, there is somebody who will give you money at the top of any current market. And if that market happens to drop by 15, 20%, which can happen in 5 minutes, they're unhappy. So who wants to deal with unhappy people? So I say they should be diversified.
I should have added that I'm not the person that has to deal with the clients. Chris DeSantis, who's sitting over the table, he's the person that has to deal with it. I agree with you, and we've seen that. We saw that with our investors through the credit crisis. We were down sharply like everyone else, and we managed to recover by the end of 2009, but the emotional pain and the psychic pain that people went through was profound. So one of the issues for us is if people are comfortable with allocating to equities. You're touching on a different issue, which is from a behavioral finance, how are they going to act and how are they going to feel? So we can tell people you should be in equities, but if they want to be more broadly diversified, it's fine with us.
Absolutely. Ira, a question for you. Your firm has been quite outspoken about the concerns out there for equity investors vis-a-vis prolonged deleveraging process in which stocks, at best, languish for several years to come. What might pure equity investors be missing?
Well, I would assume you're referring to our chief economist and strategist, Jack Pash. No, I'm sorry, David Rosenberg. David and Jack study from the Tame text, and the interesting thing, I'm an investor with Jack, and I got great respect for Jack, but Jack basically says the same thing all the time, as does David Rosenberg. So, and Rosenberg, his office is right next to mine. I talk to him all the time. He's one of the most likable, down-to-earth persons in the world. And in terms of assessing the economic outlook, he's a scratch. For those of you who know golf terms, no, I say this to his face all the time, he's tremendous. Now, when it comes to assessing markets, he's like an 18 handicapper or 23 handicapper. He's just like a regular yokel. He's no better than anybody else. And that's the problem, that the economic outlook is indifferent on a good day, and I would say the chance of a tremendous positive surprise is zero. But markets, they are unpredictable. That's one thing we have all learned, that it's very difficult to assess markets. And I think the point of view of the three of us, as opposed to my friend on the left, is that the markets do not reflect optimism, they reflect pessimism. And there's plenty of companies who can do well enough in a mediocre environment, and could easily be that their shares would go up, and then the risk-reward ratio is very favorable.
So we'll take David's comments with a grain of salt. Monish, I'll direct this question to you. Your investment style over the past decade could be characterized as focusing entirely on company-specific fundamentals in lieu of macroeconomic expectations. Is this a fair characterization? And if so, why have you chosen to manage yours and your clients' money accordingly?
Well, I think it depends on the business. So, I mean, we used to own a position in a company called Stewart Enterprises, which is in the funeral services business. And if you look at a business like Stewart, I mean, their revenues and cash flows is strictly a function of death rates. Nothing. I mean, the economy going up and down, whatever. People don't take the low bid when they're trying to bury Uncle Harry. And so basically, Stewart, for the most part, you could say, is a business which is agnostic, as much as you can get agnostic on economics. And there's a whole spectrum. So if you look at let's say a business like Caterpillar or United Rentals, or let's say Marriott, these are businesses that, of course, are very significantly affected by what's happening in the economy. And of course, we have a wide range in the middle. And so it is definitely a mistake for most companies to, I would say, ignore the macro and fixate on the micro. I think one has to have what Charlie Munger would call a lattice work of mental models, look at it in 14 different ways. But I would say that in general, as you get to smaller businesses, the macro will tend to trump the macro. A great manager or a great sales force, I mean, they're just, particular market positions and such that will trump it. And I think, in our portfolio today, we don't need the economy to do a lot of heroics for the portfolio to do well. In fact, we would probably not lose money even if the U.S. went into a recession. We probably wouldn't make the money we would make if that happened. But I don't even see that in the cards. I don't see a recession in the U.S. In fact, housing is coming back, as some of you mentioned. It's coming back in a pretty big way in the U.S. And I think housing has tremendous tailwinds. There's that. So I would be an optimist on the U.S. economy more than any other economy. I think the U.S. has many, many strengths, and in fact, the last few years has made the country a lot more competitive. So the net is, I think it's a mistake to overdose on macro. I think it's a mistake to completely ignore it. But I think one needs to look at the business and then look at the environment the business is going to operate in with different economic circumstances.
Thanks. And Murray, this question's for you. Your firm has been quite willing to tactically adjust your investors' capital between risk on and risk off investments depending on your team's expectations about macroeconomic developments. Is this a fair characterization? And if so, why have you chosen to manage yours and your clients' money using this approach?
Well, I'm going to answer this question just so Ira can take a shot at me later.
That's what we're hoping for.
Yeah, exactly. That is a good characterization of what we do. In looking at the kinds of things that these intelligent folks to my right have as their direction, we look at the world, and if you look back in history, you can see stock prices in 1999. Andrew said he couldn't find anything to buy at that time. Average PE multiples were probably in excess of 30 times earnings. If you look back to 1979, those same kinds of average stock prices were trading around 7.5 to 7.9 times earnings. So our view is pretty simple. If you have $1 worth of earnings, that stock that's trading at 30 times earnings or 30 plus is going to go down a lot if we get back to an environment again where you're looking at an average of 7.9 times earnings. And we're in the business of trying to make our clients money, but we're also in the business of trying to save them money. And so we have a belief that you need to look at the economic environment just in the same way that the fixed income guys do, that macro really matters. And so when we look at the environment today, we see something that is not particularly attractive. If you look in the U.S., debt to GDP is around 355%. In 2007, it got up to 385%. But the average from a period of time between 1900 and 1982, it was almost always around 150% of GDP, which means that we have a lot of debt outstanding in our economy, and that all added to demand for the previous 25 years. And our view is, at best, you're not going to have that additional demand. At worst, if people start to save money and pay down debt, you're going to actually have less demand. So that leads us to have an investment style which tries to look at where to put money. And Ira was quite clear about David Rosenberg looking at economics and him being really good at it. Actually, our view of the world wouldn't be much different than David's. But as a strategy, what we try to do is we try to be more tactical in our application of where we should be invested, because I think the intention is you don't always have to be invested. I think it was about 3 or 4 weeks ago I read in the paper that Warren Buffett said you should consider cash as an option. Today, he has around $41 billion in cash, and in 2007, just before the crash, he had around $31 billion in cash. Now, if he always thought you should be fully invested, that would have been invested, but having that cash allowed him to take advantage of opportunities such as investing in Goldman & Sachs convertible preferred shares at levels that most people didn't get that opportunity. And so having cash allows you to take advantage of opportunities. In the past 7 years, we've probably been fully invested in equities for about 2 of the 7 years. The rest of the time, we've had very large cash components. At some points in time, we've had up to 30% of the portfolio in U.S. Treasury bonds. And today, we have about 25% of the portfolio short equities. So we look at the world and say, where do we want to be? Where is the opportunity? And it isn't about maximizing returns. It's about trying to earn decent returns and not putting capital at risk if there isn't enough upside to make it worth our while. So we've taken a very tactical approach as to where we should be. And we feel fortunate from our investors that we aren't forced to be fully invested all the time. And we don't really compare ourselves on a quarterly basis to everybody else. And our expectation is that sometimes we're going to be on the sidelines when things go up, but we'll have that cash to take advantage of opportunities when they exist.
So when Warren Buffett was commenting on the optionality of cash, he was talking about keeping your powder dry and waiting for those deep value opportunities. When you're shifting the portfolios tactically, is it risk off mean you are going to cash or other asset classes?
Both. We have been in periods of time where we've been 100% cash. There have been times where we've been 100% equity. We've sold 65% of our equities, of which 30% was then put into long Treasury bonds because we saw an opportunity. We don't really look at the world to say it has to be one way or the other, or we don't do the same thing twice just because it worked last time. We're looking for where the value might be, and it's usually there for different reasons at different times.
And Ira, you had a comment.
Well, I'm glad that Murray invoked the sainted Warren Buffett, because I watched him on TV about a week ago, and I'm pleased to report he's still got it. And if you were to have the good fortune to listen to Warren Buffett, he would say, screw you, Murray. He would say, I like stocks. I always like stocks. I'm bullish on stocks. I got a lot of money, but he said very specifically he'd been trying to spend it. He just hadn't found the right thing. He could spend it tomorrow. And I think the big thing is Murray, to his credit, has proven that he and his associates are able to be successful tactical managers. I, on the other hand, know that I'm a 58 handicap at this. Also, I've worked with a lot of associates over the last 29 years who are equally bad. As a matter of fact, aside from Murray, I don't know anybody who's good at it. It's very, very difficult to buy, sell, know what markets are going to do. And I guess the basic thing that I learned, we were fortunate in our early days. We had some successful real estate entrepreneurs as clients. And those guys, unfortunately, they're mostly guys, not women. I've noticed that they're now multi-billionaires. And what I also noticed is they never read the paper. They never read the paper. They never diversified outside of Toronto. They never diversified outside of real estate. And they would claim that they bought in bad times, but actually they bought in good times, medium times, because they actually didn't know anything about the timing. So that's my background.
And we won't have another rebuttal, but Jonathan, how does the concept of intrinsic value play a role in the macroeconomics versus fundamentals debate? Is it harder to predict what will happen in the overall economy or what will happen to the stock price of a single company?
Sort of like Ira, I think it's really, really hard. I mean, Murray's done an amazing job, but it's really hard to make a lot of decisions and constantly get them right, and to sort of hop in and out based on macroeconomic events that are taking place around the world. I have no skill at it. We started our business in '08, and since then we had a global sort of financial meltdown, earthquakes, tsunamis, nuclear events, hurricanes, all sorts of good stuff. And if you're trying to sort of figure out also the Fed and what they're doing in QE 1, 2, and 3, if you're trying to figure out what that's going to do to stock prices and get in front of that and sell and buy, it's really, really, really hard. So I think the macro for the vast majority of us is next to impossible. The micro, I think is much more manageable, and it sort of depends on how you approach it. Sounds like a bunch of us talking today have a similar approach. We don't try and focus on 500 different companies at once and try and figure them out. We try and sort of narrow it down to just a couple and really know them well. So that's our approach, and we own 13 stocks, so it's not that many. The sort of concept of intrinsic value for me means how to figure out what an asset is worth. For us, it's trying to figure out the present value of a future set of free cash flows. So how do you do that with any accuracy? So we only focus on a few businesses, and those businesses, they don't have tons of competitors, and they tend to sell a product or a service that's essential. So if you don't have too many people nipping at your heels, then you're probably not going to have your margins erode. And if you're selling something that's essential, then it probably recurs every year. If you have recurring every year without changing in margins, and you don't need a lot of capital in your business, then you have a pretty stable set of free cash flows to value and come up with a reasonable estimate of intrinsic value. I think that's way easier for us and for me than sort of figuring out what's going to happen from a macro standpoint. So like our biggest investment benefits basically from people getting older and taking more generic drugs. And whether or not Greece gets kicked out of the EU, people are going to get older and they're going to take more generic drugs, or branded drugs or generic drugs. But there's a growth warrant there that's independent of the economy. So the 13 businesses that we own, we've picked businesses that we think can grow. I'm not ignoring the macro. The macro is pretty brutal. I mean, we're in a global deleveraging. I don't think the economy is going to grow particularly fast. But if you're hand selecting a few businesses, and our pool is North America, and thousands to choose from, you can find a few that are going to grow independent of the economy, that don't have too much competition, that do have stable margins, that do have stable free cash flows, value it, come up with an estimate of value, and then try and buy it when it's really cheap, and wait for those opportunities like Buffett does. But if you don't have $50 billion to deploy, there's a lot of opportunities.
Just to follow on Jonathan's comments, I guess our perspective is the world's really complicated, and it's getting more complicated all of the time. If you go back and look at what the world was like 100 years ago, and think about what it might be like in 25, 50, or 100 years from now, it's complicated. And so to try to get those macro calls correct, it's very, very difficult. But then we take that one step further and recognize that every single one of those thousands of companies that Jonathan refers to, they themselves are very complicated. So I agree with Jonathan. The way to really find good value is to get to know the companies, and that it takes a lot of work. And we tend to own about 25 as opposed to 13, but it's the same fundamental approach. I guess it's a value method, and so it doesn't mean that the macro doesn't matter. But when I asked one of our investors 10 years out, and he knew the CEO of the company that we owned, I said, how much of the value or the price of the shares of this company will be based on where the stock market is, and how much of it will be based on what this individual and his management team does? And he said, Oh, 100% will be based on what the management team does. And this is a macro market tactical guy. But when he got down to the specifics of a company that he knew, he reverted to what that company will accomplish. So our approach is to not try to time the market, to try to find value, and to stay invested.
I'd like to ask one more general question and then open things up to questions. So start thinking about those questions. Ira, you talked earlier about expected returns, and there still are those out there that are looking for double-digit returns. And my typical response to them is, well, that's interesting, and I'd also like to be 2 inches taller. So to what extent should investors adjust their return expectations if, over the next several years, the developed nations experience little or no economic growth? And Monish, we'll start with you.
Well, I think that my sense is that if one does the work, there are places to invest where I think returns will be pretty robust. I mean, I'd say that we're not able to find enough things to buy. So we're still sitting on I think more than 20% cash. I would love to be at zero cash, but I'm just not able to find things. But one has to be careful. So, for example, we own a position in General Motors. They are the number one market share in China, and even when you talk about China slowing down, etc., I mean, it's already the largest auto market in the world. So, like I said, I discount a lot of the macro. I would say that the Chinese growth rate would be cut in 70%, and GM in China will still do fine. So my take is actually investors can do just fine. I think the trends of all the money going out of equities and the flatlining of equities for as long as they're flatlined, those are good things for equity returns in the future.
So you were happy this morning when General Motors announced earnings 50% above expectations. So.
Actually, I haven't even seen that yet.
Okay.
But yeah, so I'm not really focused on what GM is doing this quarter or next quarter. I think that we hope to own the stock for a long time, and I think that we hope to make multiples of what we paid over that time.
So Andrew?
Yeah, I mean, it's clearly a big issue for investors, and we recently, last year, wrote a little piece for our clients, and what kind of returns can you expect? We try to take a long-term view, and the long-term nominal returns for equities are around 9.5% to 10%, and if you take a look at the rough valuation today, it's not far off the long-term average. So maybe in a sense, flip a coin looking forward for the next 5 or 10 years. As to will we be above or below that trend line. When we look at our portfolio, we do tell our investors we think we can get into the double digits, and a lot of it really relates to the cash earnings. This is echoing Jonathan's comment. We're looking at today about an 11% cash earnings yield. So our portfolio of companies, it's a portfolio of companies that on a look-through basis have zero debt. And that's in contrast to the S&P or the Toronto market that has about 2.5 turns of debt to EBITDA for the average public company. So no leverage at our companies, and you can own them at a single-digit true PE multiple. So we don't know where share prices are going in the short term, but we do know what our companies are making now. And so it's mathematically, it's hard for me not to at least say to our investors that give enough time for the fluctuations of the share prices to work themselves out, we should be in double digits.
Great. Jonathan?
I'm not sure if everyone gets the concept of the earnings yield, but if you had, let's say, a stock trading at 5 times earnings, a business you paid $5 for it and earned $1, 5 times earnings, and the management could give you that $1 every year. They didn't need it to reinvest in their business. You'd have a 20% rate of return. So yes, the world's bad, but if you could find that, you'd have a 20% rate of return, and that'd be really good. So there's not that many good businesses out there today trading at 5 times earnings, but you just heard about a bunch at 9. Ours are at 11. 11's a 9% free cash flow yield. And if you pick managers that are committed to getting that $1 back to you, theoretically, that's the return that's accumulating to you over time. So, we don't think about the world in terms of, quarterly reports on the morning of, or we think about earnings in the company I referenced earlier going, from $5 to $8 over the next 3 years. We're really focused on that 8 in 3 years. And the earnings today of that business are 11 or 12 times. They'll be like 7 times or 8 times in 3 years. It's hard to imagine that the stock's going to trade at that level. So I think, if you combine growth with a pretty good earnings yield to start off with, you have a rate of return that can get into the double digits, even in an economy that's not growing very fast. Just pick businesses that have growth drivers that are independent of the economy and buy them cheap.
Ira?
Well, I agree with these two gentlemen on my right, but I'd like to just give it a little perspective. Well, I've been on this a certain investment committee for a couple hundred years, and there was always one guy in the committee who hated stocks and bonds and hedge funds, which is what the committee did. He always wanted to talk about mortgages. He was always talking about mortgages that yielded about 9%. Forever, no one paid any attention to this guy. They all felt that the securities which we owned, which were held by the managers, were going to produce these returns in the mid-teens. Today, they've resurrected the gentleman who's got older, unfortunately, and they want to know where he gets these mortgages. And now they want to talk, for the first time in 200 years of this committee's history, they want to talk about mortgages. Now, when you pursue the topic and try to obtain this 9% yield, you'll find that it's very, very difficult. And there's a couple of these mortgage funds around are going to implode. I can 110% guarantee it, because the only way you can get 9% is by lending to bowling alleys in Belleville and to condominium sites by fourth-string builders. You can't get it anymore. The really conservative, high-quality lenders, people like Firm Capital, they've reduced their expectations dramatically. But the big thing is the majority of investors are very, very depressed. Like, all they want is this 5 or 6%. Now, if I couldn't get 5 or 6% in some of these equities, I could kill myself. These guys own a different type of stock than me. Like, I own value stocks, big time value, things like Dundee Corp sell about half of what they're worth. Half of what they're worth, and I know the assets very well. Well, sometime in the next 10 years, these asset values are going to be fleshed out. And if the bogey is 5 or 6%, so I'll go with my stocks.
I guess why you know by now. I guess you know by now why they have me on this panel. So these guys are probably some of the smartest people in the investment business, and they all look at the world and try and value companies and understand businesses. And we've chosen not to do that. One of the smartest guys in the investment business is a guy named David Swenson. He developed the Yale model, and he said you should always go where other smart guys aren't. So we try to avoid where these guys are because they do a pretty good job of what they do. We don't think we're in Kansas anymore. We think that the world is not a pretty place. Earnings today are really strong. Matter of fact, profit margins as a percentage of GDP have never been higher than they are over the last little while. And those kinds of things typically revert to the mean. They don't stay up at those levels. And the way they've got to those levels is interest rates are lower. And that means that profits increase as people refinance high-cost debt with low-cost debt. And the other thing that they've done is they haven't actually paid employees very much. So the average unit labor cost has gone down dramatically as employees have not made very much money. we don't necessarily think that can continue. So we're expecting earnings to be weak for the economy in general and businesses in general. And we think that people will be lucky to get low negative returns from the equity markets over the next little while. What we have set for ourselves, obviously we're trying to do something different. We are looking for sort of 5 to 8% returns, and that's what our bogey is, as what we're looking for. We're not really interested in relative performance. I'm not looking to outperform the S&P or the TSX. What we're hoping to do is, as I said, try and have a relatively modest to good return and protect capital.
Well, I think most investors have found out that you can't pay the bills with relative returns, so everybody is seeking absolute returns with a dampened level of volatility. And just extending a couple of the comments that have been made about some of the concerns out there and what David Rosenberg and other journalists are publishing out there about some of the concerns, what would you say worries you the most in the current marketplace? And Murray, we ended with you, so we'll start with you this time.
It's a long list.
That's right.
It's a long list.
I said the most.
Yeah, exactly. It's really hard to see what's going on. Markets, people like to make you think that there's a value to a business. And our view of the world is there is no such thing as a value to a business. Markets are made up of people. People are emotional. And they're willing to pay depending on what they think it'll be worth tomorrow or 6 months from now or a year from now. When we look at what stocks were trading at 2008, and look at where the pre-2008 and where they got to in 2009, really very little happened to the companies or the earnings, and these gentlemen will do the analysis and tell you they're still worth what they were worth before. But what the market was willing to pay for them was very different. And so what we think the governments have been doing around the world and the central banks is they've been lowering interest rates to levels that have never been before in our lifetime. It's an experiment that we haven't seen the answer to yet. And it's very easy in our view to see where the things that they're trying to accomplish will unravel. And if they do, it's really investor psychology that will be the biggest driver of what stock prices are going forward. So our biggest worry is that change of emotional stance for investors, where they go from a place today because interest rates are so low that they're driven into investments that have risk. Ira was talking about the mortgage funds. I can't tell you how many of our investors are saying that those have been the best investments they've had since 2008, and if they had any more money, that's where they're going to put them. I wouldn't disagree with Ira that there is different risk in those portfolios, and they usually come to roost within a year. They're usually good for a long time, and then the bad news comes very quickly. So when you look at what investors are doing, investors are taking more risk to try and get above government bond yield returns. And when they do that, I'm not sure that they really understand risk. What Ira was talking about earlier was those same clients that were happy with returns in the early 2000s really were unhappy in 2008, because while we as investment managers responsibly talk to them about risk all the time, they don't really hear it. And they don't really expect it's going to impact them. And when it does turn around and impact them, their reactions are quite aggressive, as they were in 2008 and what they did to stock prices. So our biggest concern is how people will react to a little bit of bad news.
Ira?
Jesus, I'm going to put Murray on Rosenberg's mailing list. Jeez, Murray, I could name 300 risks. I could name countries that are going to default you never heard of. But you know what? Like, I'm not a super optimist, but you've read about this hurricane? Now, so the hurricane came, and apparently it's a world-class hurricane. Now, and I noticed they shut the stock market for 2 days, and then they opened it up, but it didn't collapse. Now, if it wanted to collapse, there's plenty of reason. It's going to set back the recovery. If you want to be pessimistic, there are 28 1,000 reasons.
We're just looking for one.
Pardon?
We're just looking for one.
Well, my point of view is a lot of these reasons are in the paper. Not that that many people read the paper, but they are public. There's very few secret negatives that come along. And, you know, in terms of Murray's point of view, how valuations change, that's true, valuations change, but they tend to change mostly on companies with a lot of debt. And when we go back to 2008, which was only, it was only 4 years ago, it seems like yesterday, but the big thing that affected the stock market was that any company with debt was guilty. Because what the stock market said was, how can you roll over your debt? Because nobody is rolling over the debt. And what happened was that many companies really suffered. But what happened was they learned the lesson, and those very same companies that did have a fair amount of debt in 2008 don't have that debt today. And companies are very stable. Like, see, out in the audience, I can see there's a certain gentleman I know, and he sort of tunes out when it comes to securities. But what he likes, he's got some buildings that are rented out. And doesn't have that much debt on these buildings. Well, the valuation of those buildings don't really change that dramatically. The valuation of the companies that these two guys are talking about do change dramatically. General Motors is not Johnson & Johnson would be my key point.
So Jonathan, what worries you the most?
Sort of, I guess the unexpected is what worries me the most. I mean, as Ira said, a lot of the negatives we read about every day in the paper, they're everywhere. A lot of the panelists before us were talking about how awful the world is in so many different ways. But I sort of believe a lot of that's priced in. So I guess what worries me is something we haven't thought of yet. What's going to happen after the election? Everyone's sort of talking about that already. Is there are going to be lots of fights and they're going to get a deal done? I bet you they ultimately will. But because everyone's already talking about that, so for me it's what we haven't thought of already on the macro. But I don't really spend too much time thinking about it because I focus on the micro, and the earnings of the businesses we've owned since 2008. Like, it's pretty linear. Like, the earnings line looks like that. The stocks, they go like that, but they end up here and they start here, but along the way they go in different directions. But I'm much more focused on volatility in earnings and not volatility in share price. I think the value of the business doesn't change that much. I think the value of the business actually grows over time. Just the share price on a given day, which I don't spend too much time thinking about, goes up and down, but ultimately the market's pretty efficient over time. So my biggest concern, I don't even know what it is because I haven't heard of it yet. That's it.
Yeah, I would agree. When I think about the companies that we own, again, because we own companies that on average don't have debt, the ones that do have debt, it's not very much. It's very manageable. And to come back to what Murray said, it's a great counterpoint to how I think about the world, which is I recognize that share prices could compress. They could compress a lot. The markets could compress a lot from here at times if there's a continuing or a new crisis. I don't want to be too flip about it, but I don't care. And I know that my colleague Chris cares because he will have to talk to clients. One of the big advantages that I realized that we had in 2008 when our clients called us is that I was able to say, this is where all of my money is, and I don't feel poorer. And in fact, we felt great through, especially into early 2009. The thing I worried about the most at that time was that we would get a V recovery in the market. People who were around for the crash of '87, that's essentially what happened. And so I was worried there would be this trauma, it would bounce back, people would have the pain, but we wouldn't be able to do what we do partially, which is to reallocate from the companies that hadn't fallen much into the companies that had been crushed in terms of valuations. And we bought new positions in companies in early 2009, firms that we'd followed for a long time that just had never been attractive enough for us. So I don't worry, there's nothing that I worry about. I do worry with more volatility that people leave the market. I worry that my clients redeem because they just can't take that up and down price.
Right. And Monish?
Yeah, well, there is always stuff to worry about. I don't get particularly concerned about the fiscal cliff because I think that after the election they'll work it out. They have a lot of incentives to work it out. Europe still doesn't have an answer. I think that's a difficult situation. I don't know what the solution is. So that could potentially cause dislocations. But I would say even in Europe, if you own a funeral services company, it's irrelevant what the currency is. So I think it's hard to. I think like I said, if you overdose on the macro, you're going to leave a lot of money on the table.
Okay, great. We have a few minutes left, and I'd like to open things up to questions. If you have one, please step to one of the microphones and direct it to one or all of our panelists.
See, we answered all their questions.
I think you answered all of their questions. Oh,
None of your panel has talked about the resource industry. I'd like to get their views of that.
okay.
Well, I'll go first. It's easy for me to. We don't invest in basic resources, and as I say to our clients, we actually emphasize that simply because we're based here in Toronto. If we were based in New York, we wouldn't even mention it. It's not a massive component of the global economy. We also happen to not invest in biotech, but I don't bother saying that because it's a small component. So that's all I'm going to say.
Yeah, we like really recurring, high margin, high free cash flow, low capex businesses that don't have a lot of debt and don't require lots of capital. So the resource space doesn't fit that well into what we're doing. On a one-off situation, maybe we'll find something, but it'll never be material for our fund. Right now, we have one stock that's 4.5% of the fund, and we think it's going to get taken out. So it's sort of interesting, but by and large, it doesn't fit characteristically with what we like.
Well, I'm like the guy who's, is trying to hit over the water holes 450 yards. And once 38 years ago, I cleared it on the second shot. And I put it in the water for 25 years. So that's me in resource stocks, flailing away. But lately, I did discover that there was a whole world without resource stocks, and that once you divorce them, your life was a lot simpler. And that there was big money to be made. Like, if you read about hedge funds up 342% in the last 3 weeks, they're in small resource stocks. There's a whole world, and there are people who are super knowledgeable about resources. Unfortunately, they have no sense of ethics, and they share that point of view with other people in bars and places like this. So there's no room for regular boys and girls like us in those securities.
Murray, any comments on resources?
Sure. I think we're more agnostic than the rest of the crew. We like resource stocks sometimes. We don't like them others. Today, since we don't own any equities, I think it's fair to say that we don't like resource stocks any more than anything else at the moment.
Monish?
Yeah. In the 13-year history of the funds, other than maybe a small exposure from time to time in the oil industry, we basically had no exposure to resources except in the fourth quarter of 2008. In the fourth quarter of 2008, we went very heavily into resource stocks. In fact, the biggest winner we've ever had in the history of the fund was a Canadian company, Vancouver, Techcominco, and it was about 8x from what we paid in 2008. And I think resource stocks actually lend themselves very much lend themselves to a value analysis. But for the most part, they're not trading at prices that are interesting. So for example, if you bought a iron ore company that had on the cost curves sitting in the first quadrant of cost curves, which means the bottom 25 or even the bottom 50% of costs, and you can analyze cost curves in these resource stocks. Basically, the marginal producer will set the price for the most part. Very few times will resource stocks trade below marginal price of production. So basically, you can tell what your let's say minimal margins would be, and so if you own high quality assets, which I define as first quadrant critical assets like metallurgical coal or iron ore and that sort of thing, you buy them at the right price, you will do quite well with them. That is not the case today. And in fact, other than when I found them in the fourth quarter of 2008 and in early 2009, it has not been the case since. But if it got to that point, we'd be happy to step back in again. So.
And before we head to the 19th hole, we can take one more question.
There's one over there on the far right somewhere.
Yes, sir.
Ira talks about divorcing himself from resource stocks. You can't divorce yourself from the effect that the global demand for resources has on the value of the Canadian dollar. So, for anybody who's interested in talking about it, most of the people in this room live in Canadian dollars. How much time do you spend worrying about the long-term value in Canadian dollars of that dollar?
So, are you going to address that? Do you want to repeat the question? It was really talking about the resource sector and the impact on the Canadian dollar and the impact of the Canadian dollar on the other holdings in your portfolio. Did I get that right, David?
I'll start. It's the way we think about. We want to own companies that are naturally hedged. In other words, if they operate in Europe, they have their costs in Europe, they have their revenues in Europe. So we don't like companies that are, for example, making something in Canada, selling it into the US or vice versa. So we really focus on that. Over 70% of the revenue of the companies in our portfolio arise from outside of Canada, and the majority actually arises from outside of North America. So while we generally own North American and primarily somewhere in Canada head office companies, they operate globally, some of them in a niche global, some of them globally overall. And then what we tell our investors, and we say to our US investors, our returns have been harmed over the 14 years because look at what the Canadian dollar has done. But I wouldn't say that our returns have been harmed because we own something that was manufacturing something in Canada and shipping it to the US. We were careful to avoid companies like that. So there'll be ups and downs, but whether the dollar's at $1.10 or at 90 cents, other than the impact it has on our share prices of our companies, which is 10% plus or minus, I don't think it'll have an effect on us.
We hedge the dollar. I think we're pretty good at finding a business at $10 a share and seeing it go to 20, and I don't want to layer on the additional bet of currency when I have no great skill in it.
Murray, anything to add to that before we wrap up?
Sure. As usual, we do things differently. We actually manage currency as a separate piece to our portfolios. Sometimes we're long US dollars, sometimes we're long Canadian dollars, and sometimes we're flat if we think there's no advantage. Currently, we have a 24% exposure to US currency in our portfolio, which is at the high end. We've been as low as 0 and as high as 40% over the last 7 years. We think currency is a piece which can add performance to a portfolio over time, and I don't know that we have any insight as to what's going to make it move up or down this week or next week, but with the Canadian dollar having been trading at a premium to US dollars, we do believe that there will again be the flight to safety in the US currency, and again, we would like to have greater exposure to US currency at these prices.
And Manish, I'll invite you for one final comment on the currency side.
Yeah, so I have actually no view on the Canadian dollar. Actually, I have no view on most currencies. Most of that is outside circle of competence, so I don't even go there.
Okay. Well, I'd like to extend my sincere thanks to the Prime Quadrant team, to Ian, Mo, Jeremy, Yael, and Seth. It's been a fantastic day. When you look at the range of speakers that we've seen today, between fixed income, real assets, private equity, and now the hedge funds and public equities, I mean, it sort of speaks to the philosophy at Prime Quadrant to look to experienced managers and diversify your portfolio well. So I'd like to thank our 5 panelists and for you, to you for the courtesy of your time.